Hey everybody, welcome back to Actual Investing. I have a bit of a different video for you today. It's a cozy rainy Saturday night while I'm recording this, and on the weekends when the market is closed, I sometimes like to check in with my portfolio and make sure that everything still looks good and make sure that my portfolio is still aligned with my long-term goals. And so I thought I'd take today while the market's closed and while I'm just kind of sitting around the house not really doing much and talk to you guys about what I look for when finding a good company to invest in, because like Warren Buffett says, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. So I'm going to show you how I find those wonderful companies, in my opinion, in the first place. And I'll go through an example with a company that I own and happen to like a lot so that you can see the things that it's doing well and the things that it's not doing well. And maybe you can put this into practice with your own portfolio. So let's just dive right into it. The four things that I look for, valuation aside, in a wonderful company are the business model, the balance sheet, the income statement, and how the company thanks their shareholders, which only applies to certain stocks, but we'll get into that. So let's start with business model. For me, a company's business model is only going to work long-term if they have some kind of recurring revenue, something that brings customers back and spending money year after year. So the four ways, in my opinion, that a company can have recurring revenue are through consumables, aka selling something that can be consumed and repurchased, services, subscriptions, and platforms. So let me just talk about each of those four business models so you can see some examples and find out if the stocks you own fall into one of those four categories. So for consumables, we have things like Starbucks, where you buy a latte and drink it, and you're going to have to come back next time you're thirsty and craving a latte, or Thermo-Fisher Scientific, which is actually going to be my example for this presentation. Here's a slide from Thermo-Fisher's investor relations deck, which shows that their revenue breakdown is 83% services and consumables. So we see that 83% of Thermo-Fisher's revenues are recurring. So I would say that that is a good business model. So step one, business model, check. We can say they have consumables revenue. That is a recurring revenue business. I like to see it. All right, let's look at the other three types of recurring revenue businesses now. The second type is services. Now, this one's a bit broad because a lot of different things can be a service, and especially now as you have companies that are SaaS or software as a service, that really broadens the scope of what a service is. But I picked three companies that are on my watch list that I think fit in this category. Intuit, primarily TurboTax is their main product, right? Every year when you need to file your taxes, you use their software as a service to file your taxes. Now, I hate that I have to do that. I wish I could just file my own taxes for free, and it sounds like the IRS is implementing that. But anyway, that's a tangent. UPS is a service, right? Shipping services. Anytime you order a package, that company is going to pay UPS to deliver that package to you and probably charge you for the shipping in the process. So that's a recurring revenue. PayPal, to a lesser extent, is a service. They're a payment processor. So if you need to make a purchase, you use PayPal and they take a little cut, and that's the service that they provide you, the payment processing. The third type of recurring revenue is subscriptions. So I think the obvious ones are Netflix, Spotify, Disney, but also companies like Adobe, where you purchase Creative Cloud and pay a little bit every month. That's pretty much the most predictable recurring revenue there is. As long as people don't cancel, you're going to get the same amount month after month. And when things start to slow down, you just raise your prices like Netflix does. And finally, we have platforms. Now, platforms are a bit more complicated to explain, but I think when you think about these three businesses, you can kind of understand what they do. It's a platform where many users can go on and use the platform, and the platform owner takes a cut. So you think about Airbnb. Airbnb, for the most part, doesn't actually rent you the home. An independent landlord will rent you out a short-term home, post it on Airbnb's website, and Airbnb will take a cut. Same thing with Uber. Uber doesn't actually drive you around. The independent people who drive for Uber drive you around and use Uber's platform. Uber takes a cut. So that's also recurring revenue because as long as people are traveling or as long as people are carpooling, you're going to be getting that recurring revenue. So hopefully that makes sense. If you're looking at a new company and it doesn't fall into one of those four categories, this next slide might be for you. So non-recurring revenues should always be accompanied by recurring revenue. So even if your company does not fall into one of those four categories, it might still be a wonderful company. So let's talk about a good example, Nintendo. Now, I'm a little biased because I grew up playing Nintendo consoles, playing Nintendo games, but I think they have a really good non-recurring revenue business that comes with recurring revenue. So you think about the main product that Nintendo sells, which is the Nintendo Switch. That is not recurring. You buy one Nintendo Switch, and as long as you don't break it, you're going to use that Nintendo Switch for the rest of its lifetime. Now, you could say it's recurring revenue because they're coming out with new products every few years. However, it's technically not recurring because those are different products, in my opinion. However, what Nintendo does well is that they have sources of recurring revenue. So you can pay for a subscription to Nintendo to use online features. So think about when Animal Crossing was really big and everybody was at home playing Animal Crossing. If you wanted to visit your friends, you had to pay for a Nintendo subscription in order to do that. So they have that. They also have their little app store, which is also recurring revenue. So I think that's a great business where you're selling something that's one time and then accompanying it with recurring revenue in the form of games, in the form of subscriptions. Let's take a look at a not so great non-recurring revenue business, Shark Ninja. So Shark Ninja might still be a good business for some people, but for me, it's not a wonderful company because if you buy a blender or you buy a vacuum, you're good. As long as you don't break it, you're going to be able to use that blender or vacuum for as long as you need. And now the flip side is, well, maybe they're going to make products that intentionally will break after 5 years, but who's going to buy a blender or vacuum that intentionally breaks after 5 years? You see what I'm getting at? So that's not a good recurring revenue model. I hope that this sort of makes sense and that I'm not really mansplaining things to you because I'm not trying to. All right, so now that we talked about business model, let's talk about the second thing I look for, which is balance sheet. So I just have 3 points here. Cash is king, so look at a company's cash balance and make sure that they do have enough cash on their balance sheet to pay their short-term liabilities. Anything that's coming due soon, they need to have that cash or be able to make that cash. I like to see assets being greater than liabilities. That's known as shareholders' equity, and I like to see that being positive. The exception would be if you have a company that generates a lot of cash flow, like a company like MSCI or Starbucks, which are both underwater on their balance sheet, but are both quite profitable. And then the other thing to look for is if a company does have a lot of long-term debt, when does that debt come due? When are they going to need to pay it? If it's far in the future, they have time to rack up the cash to pay it. But if it's pretty soon, you may need to be a little bit worried about this. So let's take a look at Thermo-Fisher, our example, and find out how their balance sheet looks. Okay, so Thermo-Fisher's balance sheet looks on the surface fine. So what we see here is $8 billion in cash, so that's wonderful. This is a profitable company, which we'll get to when we talk about the income statement, but it's nice to see that they do have cash on hand. They have total assets of $99 billion, and they have total liabilities of $52 billion. So their assets are higher than their liabilities. That's good. But wait. Let's look into what those assets and what those liabilities are, because it's not quite so cut and dry. Here's Thermo Fisher's balance sheet. This is just found on their investor relations page. And we can see that some of this assets is actually goodwill, which is an intangible asset. So without getting too much into accounting, it's important to note that tangible assets are things that can be objectively ascribed a value. So they have a factory building that is worth $3 billion. Okay, we can see that factory building. Yeah, that makes sense. A factory worth $3 billion. Nobody's going to question that. Intangibles are things like goodwill or patents or licenses where you can't necessarily put a value on it. Goodwill is one of those sort of black box accounting terms, which I won't get into today. But essentially, Thermo Fisher is a serial acquirer, which means they do a lot of acquisitions. And oftentimes, if you overpay for an acquisition, you get this asset on your balance sheet, which is known as goodwill, which is essentially just the amount that you've overpaid. So realistically, Thermo Fisher's balance sheet is not as strong as it looks because $44 billion of their assets are not actually tangible assets. So without diving too much into it, let's just say Thermo Fisher's balance sheet is fair. All right, let's keep going and look at the income statement. So the income statement is probably one of the most important things, especially if you are a growth investor. So on the income statement, one thing that's important to look at is, are revenues growing year over year and are earnings growing year over year? And if not, are they going to resume growing in the future? Well, we also need to look at our margins. So the income statement not only shows your top line, which is your revenues, but your bottom line, which is your earnings. And a company's margins represent the power that they have to leverage those earnings. So let me show you an example with Thermo Fisher once again. Here's Thermo Fisher's income statement over time. We see that yes, their revenues and earnings were growing. And this is just Google Finance, by the way. This is readily accessible. You can see that Thermo Fisher's revenues are growing, but suddenly they stopped. So that is a red flag. We would need to look at the company's guidance for the next year to see if we think that's going to resume. I did look at the guidance. They said revenues are coming in at 43 to 44 billion for 2024. So they are starting to grow, but they're not quite at the same point they were in 2022. So let's keep that in mind as we look at Thermo Fisher, because for a company that is not growing their revenues, they should not be valued like a growth stock. They should be valued like a value stock. We'll talk about that a bit more later, but essentially, a growth stock is priced based on their future earnings and cash flows, whereas a value stock is valued based on their current earnings and cash flows. The next thing to look at on an income statement, and here's Yahoo Finance, is your margins. So what we can do is look at total revenue and cost of revenue. This will give us your gross margins. So see this here, gross profit is going to be your total revenue minus your cost of revenues. For Thermo-Fisher, the gross profit looks pretty good. Just doing some mental math. 17 billion is give or take 1/3 of 42 billion. So we see that Thermo Fisher has gross margins of about 33%. My minimum for investment is around 20%. So that checks all the boxes. But now let's look at some other aspects of the income statement. Selling, general, and administrative is probably one of the bigger expenses that most companies have. So for growth stocks that are growing heavily, you often see this being very high. Sometimes it's even more than their gross profit. So a lot of times growth stocks are spending more to make business than they are actually making income. And that's because they're trying to capture market share for profits in the future. It's all about profits. It's just about when. So here I look at selling, general, and administrative as a percentage of gross profit. So this looks like about 50% of their gross profit is going to SG&A. Okay, the next thing to look at is R&D. Research and development is pretty much what it says, researching and developing products. Warren Buffett likes research and development to be less than 50% of a company's gross profit, so that's what I like to look for too. Here we see that research and development is only about 10% of the company's gross profit. So SG&A and research and development together are only between 50 and 60%. So to me, that shows a company with good profit potential. And that's what it's all about on the income statement. So Thermo Fisher's income statement also is fair. And finally, let's talk about thanking shareholders. So this doesn't really apply to growth stocks because oftentimes growth stocks will not have profits. They'll be focused more on revenue growth. But for established companies that have been around a while that are showing profits, investors that have been waiting and waiting and waiting want a little bit of a payday. So there's two ways that a company can pay their shareholders, through dividends or through stock buybacks. There's an argument that both of these accomplish the same thing, but let's look at both and find out how Thermo Fisher is doing with these two. So here's Thermo Fisher's investor relations page again, and this shows their equity dividends over time. For those unaware, a dividend is simply a cash payment made by a company to their shareholders. Usually happens once a quarter, and this you'll only find with value or blend stocks, not so much with growth stocks. What I like to see is that Thermo Fisher's dividend has been growing in recent years. Ignore this because 2024 hasn't ended yet. But what we see is that even while their revenues were flat, remember how on their income statement the revenues kind of trailed off? They've been increasing their dividend. So while they haven't been capturing as much market share, they've been returning more money to shareholders, which is really cool to see. So the other way that a company can repay their shareholders is through share buybacks, where essentially the company goes out, takes their cash that they made from the business, and buys their own stock, which sounds a little bit strange, but what you're doing is essentially giving your shareholders a bigger piece of the pie. So let's look at this graph here. This is Thermo Fisher's shares outstanding over time. What I like to see, this is over 5 years, is that the shares outstanding are decreasing. So if you had bought shares of Thermo Fisher back 5 years ago, you would now own a bigger portion of the pie because you held those shares for those 5 years and Thermo Fisher has bought back shares. The opposite of this is called dilution, when a company issues more shares or sells shares via a secondary offering. That's where your company is essentially using you as a bank and you get less and less of a piece of pie. You see this sometimes with biotech companies that need that money in order to develop expensive drugs, or new growth stocks that are just running short on cash and need to survive. To me, if I see this shares outstanding going up, I usually will take that as a sign that I might need to look around for other opportunities because I don't want to be used as a bank. So we talked about Thermo Fisher today, and the reason I use Thermo Fisher is because it's a company that I own, it's a company that I think is a pretty strong business, and it's a company that I think can appeal to both value and growth investors. So as we talked about, value stocks are seeing profits today. They're usually a little bit less risk, they have lower valuations, and they tend to pay a dividend to reward shareholders right away. Growth stocks are kind of the opposite. So growth stocks usually don't have profits now. What you need to look for with growth stocks are gross margins to show the potential for profits and revenue growth. So if they're growing their revenues year over year over year, that's great because they're capturing market share that they can eventually milk and turn into profits. The type of investing that I like to do is called blend, where you get a little bit of both. You get a little bit of revenue growth and a little bit of returning money to shareholders. So think something like Thermo-Fisher or NextEra Energy. Those are types of blend stocks where they're growing and also returning capital to shareholders. That's all for my presentation today. We can talk more about valuation and other things later, and I do have a snowflake video coming next because a few of you requested it. But if you like this type of content, let me know because this is quite a bit different. I just thought I'd give you guys a little bit of some tidbits of what's going on in my brain for this cozy Saturday night. I'll probably post it on Sunday, but still, it's the weekend, the market's closed. I figured let's take a break from looking at individual stocks and kind of focus on the big picture. So anyway, if you did like this, please hit the like button. I think that helps the algorithm. If you disliked it, hit the dislike button and leave me a comment letting me know what you disliked, just so that I can, improve and become better at delivering content to you guys. And please subscribe also if you're new. Anyway, thank you guys so much for watching. I hope you enjoy the rest of your weekend, and I hope for great returns on Monday when the market opens, right? Anyway, thank you guys. Have an awesome day.